What's up, friends? This is Manoj Paptani. I welcome you all on behalf of the Edupedia world. It's a beautiful day outside, and certainly I am sure that you guys are enjoying your level best life in a best possible kind of manner. So, guys, this is the ninth video presentation in which we'll be understanding the other relevant aspects relating to the topic of equity analysis and valuation. By now, we have already covered equity analysis and we have started our portion covering the topics relating to equity valuation. So in my last segment, we did discuss about various aspects relating to valuation, valuation process, and how about going forward towards estimation of the free cash flows, whether it's for firm or for the equity. So in this basic presentation, I'll be talking and discussing the relevant remaining parts, which will be like in continuity to estimation of free cash flows only. So in this video presentation, I'll be talking about the remaining portion in which that will be in continuity the estimation of the free cash flow in some different scenarios. Perfect, guys. So let's start with today's presentation. The first topic will be forecasting the free cash flows for the firm, free cash flows for equity when the components of the cash flows are tied to sales forecast. So, in my last lecture, I talked with you guys regarding the understanding of the concept relating to the estimation of the free cash flows, whether it was for firm or for equity. In this basic slide, I'll be talking about like if in case these cash flows are tied to a sales forecast, then in that sense, what will be our prerogative to solve out that question and how we'll be like moving forward, how will we like strategize to solve that kind of question if in case that appears. So definitely in this presentation, I'll be discussing with you one of the question which was asked in CA final examination for June 2009 as well. So there we'll get an idea as to how some certain kind of questions are required to be dealt with during examinations. Perfect, guys. Let's start with this basic thing. So in order to understand this particular thing, whenever the sales forecast is basically available, in that case, guys, we need to forecast the components of the free cash flows by evaluating and capturing the complex kind of relationships among the components of free cash flows. So in this kind of segments, usually we use sales forecast and tie them to the components of free cash flows for the firm. Frequently, in order to make it in a better and a simpler way, a convenient assumption is made that non-cash charges which are consisting of a depreciation expense only. So this is a kind of assumption which is being usually taken up which are involving in the financial world. This particular kind of assumption is primarily used by many of the authors. So the convenient assumption is that all the non-cash charges basically consist of only depreciation expense only. Though in the natural world it's not feasible, but still as far as the examination point of view is concerned, definitely we will have to assume that it contains only depreciation expense. So in that case, what will be? So if this basic assumption holds, then the free cash flows for the firm can be calculated as EBIT 1 minus taxes minus net fixed capital investment, that is FCINV, less the working capital investment, that is WCINV. So in this basic kind of situation, the net investment in the new fixed asset is the investment in property, plant and equipment in excess of depreciation. It is being told. Okay. And in this particular method, often, like I have seen, many of the analysts usually start with the sales forecast only. And after they have like analyzed the historical operating profit margin and the various ratios, primarily the two of them, and which are the net investment in new fixed asset with the sales increase divided by that and investment in working capital divided by the sales increase. These are the basic two ratios which are being primarily used by the analysts in this profile. So if in case the future values of these ratios are established, the sales forecast is used to arrive at the free cash flows for the following various kind of approaches. So in order to forecast the free cash flows for the equity, so practitioners usually frequently use one additional assumption, which is they recognize that the new investment in the fixed asset and working capital is partly financed by issuance of new debt, that is any kind of new borrowing. So that's their kind of assumption. and they often assume that the specified percentage of the net new investment in the fixed capital or the increase of in the working capital is usually financed with the target ratio of debt. So what this particular thing is all about, so we can express this into this kind of concept. So herein free cash flows for equity can be evaluated by adding up the net income. So herein the net income minus FCINV, that is the net fixed capital investment less depreciation as it's being told over here, minus WCINC, that is INV, that is called working capital investment, and we'll be adding the net borrowing over here. Remember guys, I did discuss you about the topic relating to why net borrowing is basically added whenever we are actually heading towards finding the calculation for free cash flows for equity. It is basically added because this portion allows the equity holders to increase their stake of cash flows in the firm. So if you are like supposedly required to pay a debt borrowing of rupees, like repay a debt borrowing of rupees 1 lakh, and if in case you go for another kind of bank opportunity wherein the bank allows you to go for additional kind of loan, let's say rupees 5 lakh, so you have basically got the additional cash flow in your pocket of rupees 4 lakh, though you'll have to pay it later on various intervals of time, but as far as this present moment is concerned, you are having more of the cash liquidity in hand by taking up that loan. Okay, so that is why this net borrowing amount is basically added, because cash flows are increasing over here. So that's the basic thing behind it. And in case of this FCINV, if we'll be talking about this, so here the depreciation, FCINV minus depreciation. So this is guys basically the incremental kind of fixed expenditure which is net of depreciation. Depreciation is a non-cash item guys, remember always. So since it's a non-cash kind of element, so we'll have to deduct it, because our initial cash flows from this net of expenditure is actually not going out of our pocket. So our money which is going out of our pocket will be only FCINV minus depreciation. So that is the thing. And if we use the target ratio, so let's suppose what is target debt ratio basically. So if in case we use target debt ratio, that is DR, we can simply write it as this particular formula. This particular concept basically allows you to go for this kind of approach wherein you use target debt ratio. So which is FCFE, that is free cash flows for equity, equals to net income minus 1 minus debt ratio, target debt ratio, into FCINV minus depreciation, that has already been discussed in this part, minus 1 minus debt ratio into working capital investment. So how this is being evaluated? In case of any kind of net borrowing, we'll have to understand one thing. So net borrowing basically allows you to go for this particular segment wherein you get to know that net borrowing is equal to target debt ratio multiplied by FCINV minus depreciation, okay, plus debt ratio into working capital investment. So why are we like talking about the target debt ratio? Because target debt ratio is equally impacting. Debt ratio basically impacts this fixed capital investment plus working capital investment as well. So that is why that is being multiplied by this 2. So debt ratio multiplied by this plus debt ratio multiplied by this. So we'll get the net borrowing in such case. Here, net borrowing can be obtained using that kind of concept. So here, this is basically a way with which we can avoid forecasting any kind of net borrowing directly. So it is enough to like forecast any kind of sales, net profit margins, new net kind of investment to arrive at free cash flows for equity. And if these two assumptions do not hold, that is, for example, if in case debt ratio is not stable and there are other some significant kind of non-cash expenses other than depreciation as well, then in such case the forecast would not be very precise, guys. So for that reason, analysts usually like always conduct research time again that way in order to determine whether they are like actually having the planned kind of future investments or are there some changes in the capital structure or not. So that is why they basically do these kind of things. So certainly I do believe that you guys got some kind of clarity as to how this sales forecast is basically tied to free cash flows for the firm and free cash flows for the equity. I know this concept is basically a bit difficult to understand. Henceforth, I have actually included a kind of example which is one of the questions which asked in CA final examination for June 2009. Therein, you will be getting the entire conceptual clarity as to how this concept moves forward. So let's discuss that example first. So this was the question which was being asked in CA final examination for June 2009, and that was calculate the value of share from the following information. Profit for the company has been provided to us, that is rupees 290 crores. Equity capital of the company, that is rupees 1300 crores. So it is being provided to us. Par value of the share, that is rupees 40 each. It has been provided to us. So since this is the question which has already been provided to us, with this we can simply say, in case we'll have to calculate the number of shares, we can easily get it because we have been provided the equity share of the capital. Equity share capital of the company, that is 1300 crores, and the par value of the share, that is 40. So we can simply get the number of shares by dividing 1300 from 40. So in that way we can progress towards the solving of the question. Next came in as debt ratio. Debt ratio has been provided to us, that is 27. So that means that is 0.27% if you'll be talking about in that percentage in times. Apart from this, long run growth rate of the company has been provided to us, that is 8%. Beta has been provided to us as 0.1, and risk-free interest rate has been provided to us as 8.7%. Market return is 10.3. So basically this information will be helpful while calculating the CAPM data. Remember guys, CAPM. So herein risk-free rate will be 8.7 plus the kind of beta 0.1 multiplied by 10.3 minus 8.7. So therein you will be getting the kind of CAPM data. Capital expenditure per share, that is 47 rupees. Depreciation per share, that is 39 rupees. And finally, the change in the working capital, that is 3.45 per share. So it has been mentioned, and we'll have to calculate the value of the share from the following information. Ready guys? Perfect. Let's move towards solution of this question. I have wrapped it, not a tabular presentation herein, because that would have confused you a bit. So I have gone for a simpler way. Let's understand this solution in that sense. So the value of any kind of equity share can be obtained by using the value of equity divided by the number of shares. So therein you will be able to achieve or calculate the value of a single equity share. Value of the company is basically the discounted value of all the future cash flows. It has been discussed with you time and again. So what is the value of the company? It is basically equals to the discounted value of all the future cash flows. So herein, the first step which I told you back. So equity share capital is rupees 1300 crores. Par value which has been provided to us as 40 rupees. This was given in the question. So herein I can simply calculate the number of shares, which is 32.5 by dividing 1300 crores by 40. So the number of shares issued were 32.5 crores. The PAT which has been provided to us, PAT, profit after tax, as rupees 290 crores. Depreciation has been provided to us in terms of rupees. So depreciation is 39 rupees per share. So we will be multiplying the same with the number of shares, that is 32.5 crores. We get the overall depreciation, that is rupees 1267.5 crores. Capex, capital expenditure per share, has been provided to us, that is rupees 47. Similarly, we'll be multiplying the same with 32.5 crores, that is the number of shares issued. We'll get the amount of rupees 1527.50 crores. Change in the working capital, same case, 3.45 has been provided to us in the question. We'll be directly multiplying the same with 32.5 crores, and we'll get as rupees 112.125 crores. Target debt ratio has been provided to us as 27. If we'll be dividing the same with 100, we'll get a figure of 0.27, which is the target debt ratio in this present question. So now the final solution part. This is basically the kind of things which have been provided to us, which were given in the question, or we can simply go for obtaining the same with the help of that given question. That was the simpler part. Okay. Now the basic complication starts, wherein we need to solve out the remaining portion, the main portion of this question. So remember guys, I just narrated to you the basic concept regarding the free cash flows for equity, which can be obtained as the net income minus 1 minus debt ratio into FCINV, that is the fixed capital investment, less depreciation. This concept has been clearly mentioned to you. So do keep that in mind as to why depreciation is being subtracted from fixed capital investment, less 1 minus DR, that is 1 minus target debt ratio, into working capital investment. Okay, so by implementing this concept in this particular information, we can get the results as 290 was my net income, that is the PAT, less 1 minus 0.27. 0.27 was my target debt ratio, into 1527.5, that was my fixed capital expenditure, that is my Capex, minus 1267, that is my depreciation, minus 1 minus 0.27, again that is my target debt ratio, into my working capital investment, that is 112.125. So herein I get the value as a free cash flows for equity as rupees 18.35 crores. So guys, simple. Now you can easily relate to how this concept is being used while going about solving the questions relating to the topic of estimation of the free cash flows for firm or equity with sales forecast. So this is how it is basically being done. Okay. So next part comes as the cost of equity. So again, the CAPE model. Remember guys, risk-free rate plus beta into market rate minus risk-free rate. So here we'll get it as 0.087 plus 0.1 was with beta into 0.103. 103 was my market return minus 0.087, that was my risk-free rate. The cost of equity will be 8.86%. Now the same will be implemented while going forward towards obtaining the valuation of the company. Value of the company will be the discounted value of all the future cash flows. Okay. So herein the same would be 18.35 crores, which was available over here, free cash flows for equity, into 1 plus G. 1 plus G basically means the growth rate. How about growth is going on? So this growth rate was mentioned to us in the question that was given, divided by K minus G. So 18.35 crores into 1.08 divided by K, that is 0.0886 minus G. So this is basically a kind of model which is being presented in the dividend valuation. So I know we'll have to cover this topic in our forthcoming presentations as well, but still this was a brief idea as to how it is being quoted out. So discounted value of all the cash flows, wherein free cash flows for equity into growth rate divided by KE minus G. So herein the value would be rupees 2304.26 crores, and therefore in this case the valuation of per equity share would be rupees 2304.26 crores whole divided by the number of shares issued, which were 32.5 crores. So herein the valuation for a particular equity share would be 70.90. So guys, that was all about the question relating to the obtaining for estimation of the valuation of the free cash flows for the firm as well as for the equity using the sales forecast. Guess you guys got that clarity as to how to move forward towards obtaining the kind of result while performing this kind of analytics and questions. So I'm sure you'll be able to get an idea as to how that can be done. Perfect guys, in my next presentation I'll be starting out with the present value valuation models, wherein I'll be discussing with you the major two of the models. That will be dividend discount model. So that will be helpful while discussing the content for dividend valuation chapter as well. Apart from that, I'll be also discussing with you about another kind of valuation model, wherein we'll be using technique approach for discounted cash flow approach. Discounted cash flow approach plus dividend discount model. Till then, I'll be concluding my video with the tools of motivation herein, and that will be: they can conquer who believe they can. They can conquer who believe they can. This quote was being mentioned by Virgil. Virgil was a superstar of his all time. So he has actually mentioned it very right. So all those persons who were good part of philosophers, the ones who believe that they can change the world, are the ones actually who change it, right? So the persons who believe that they can conquer any kind of idea, any kind of relationship, any kind of good profession, so they are the ones who believe, and they are the ones who believe they can. So certainly the first belief is extremely important to go for any kind of idea. You'll have to first believe out in yourself. Only then you will be able to achieve any kind of thing in your life. So first of all, that dream has to be seen. Dream for conquering any kind of idea, any kind of business, any kind of relationship. That has to be seen first of all. And only then you'll be able to manage out winning hearts of people anytime, any day. So they can conquer who believe they can. Virgil. With this, I'll say a thank you on behalf of the Edupedia world. Keep interacting guys via questions, queries, YouTube comment boxes. Stay connected. That will help us in understanding your needs way better. And we love to receive any kind of feedback from your end. That will help us in improving and enhancing our moral support as well. Perfect guys, take care. I love you. God bless you all. Bye.